Hi there. If you've been following our webinars this year, you would have had your trading knowledge enriched with an understanding of how the most popular indicators work and what they're all about. You should now be able to interpret the historical data they leave behind, and with a good amount of practice and self-application, you'll be well on your way to becoming a super trader.
But there is still one question that is probably plaguing you. Even though I have all these cool tools and whatnot, how do I manage my risk and keep from exposing myself too much? There are many layers to risk management, and in this video, we will be introducing you to a basic discipline that we'd love for you to start off with as a brand new trader. If you already have a risk management strategy, watch the video anyway. You never know what you might learn. Of course, we won't leave you hanging when it comes to deep stuff. We got you! Our sister company, the University of Forex and Gold, released an amazing course called Forex eLearner Pro, if you haven't already heard. If you are interested in going from zero to hero in the Forex trading market, then get a hold of us ASAP so we can offer you an amazing reduced launching price. Within this course is an in-depth and multifaceted approach to risk management that works closely with your psychology to help you understand Forex in the best way you can.
Back to basics. We will go ahead and use an example to build a scenario so you understand what we are teaching you as you grasp the concept. So our example balance will be $1,000, which is roughly 10,000 rands. The first thing we will do is figure out if we are willing to risk 2% or 3% of our account per trade. If we decide on 2%, then we'll be risking $20 per trade. This means that we do not plan on having a loss greater than $20 for any one trade. Because of this, we accept that we will experience loss, but it's on our terms.
Secondly, when trading, the aim is to grow your balance, but the reality is that losing will happen. Everybody experiences loss when trading. The great traders are just better at managing their losses. By using a good risk-reward ratio, a trader can make sure that they make more than they lose. This obviously requires discipline and self-control, two things you simply cannot trade without. To manage your greed and fear, always check yourself.
A risk-reward ratio of 1-to-1 means for every $1 you're willing to make, you're willing to lose $1. That doesn't really do much for you if you're going to make $1 in one trade and lose it in the next. You want to have a good return on investment. If you were to have a risk-reward ratio of maybe 1-to-2 or even 1-to-3, it will allow you to make $2 or $3 when you lose $1. Now that's beautiful. I'll also get into why we don't want you to get carried away and use a risk-reward ratio of 1 in 4. It isn't a case of the highest number is better. So if we choose a risk-reward ratio of 1 in 3, this means we risk $20 in one trade, but we stand to make $60. Now that's music to my ears.
Next, we will set goals. This will allow us to deal with days when we do not see the movement we want to see, and it will help us to get what we want the most. Maybe you're trading Forex for extra income because you want to start a college fund for your kid or you want a new car. You need to know the path up the mountain you will be taking. Our goal setting is tri-pronged. You will first decide what you want to make a day or a week according to your schedule, because not everyone will be able to trade every single day. I don't want to pressure myself because I am still learning, so I decide on $200 per week. That means all I have to do is place 4 good trades between dropping the kids off at soccer or attending meetings for work, and I can make 60 in one trade, so the target is to make 240 in those 4 good trades. But the plan is to take 200 home, so that leaves a chance for 2 sour trades that lose me $20 each. Making sense? Unfortunately, there will be those days when you don't even manage to make the 200. On these days, I am okay with a minimum of $120. That is roughly 2 good trades.
Now that we have that and we know what we can make, we need to know what stop loss and take profit values to use. Now, as a novice trader, we would like you to start trading intraday. The psychology of trading is quite intense, and we do not want you up at 2 a.m. in the morning tossing and turning because you're anxious about an open trade. We will open and close our trades within the day. Because of this, we will not be aiming for hundreds of pips. Our stop loss take profit ratios, in accordance with our risk reward ratio of 1 and 3, will be 20 to 60 or 25 to 75 or even 30 to 90. Now, you don't want to find yourself placing a stop loss of less than 20 pips. You're likely to get stopped out even when the movement is in your favor, simply because of fluctuations. So take note, your stop loss should be 20 pips or more. For those who are itching for it, now we will decide on our volume. We do this last because often we overexpose ourselves by choosing the size of our trades without considering the size of our accounts themselves. We will use this simple formula for this. The amount of reward over the pips for take profit will equal the amount you've earned. The amount of your risk over the pips for stop loss will equal the amount that you are in a minus. You can use either the take profit side or the stop loss side, but you don't have to use both. Here goes. We will use the first pair of stop loss and take profit values. $60 over 60 pips equals $1, and this means that you'll have a volume of 0.10. $60 over 75 pips will equal 80 cents, and this means that you'll have a volume of 0.08. 60 over 90 pips will equal 70 cents, and this means you'll have a volume of 0.07.
So if you want to place a wider stop loss to give your trade more breathing room, make sure that your volume is adjusted along with the number of pips so that at the end of each of the trades you place, you either make 60 or you lose 20. Just to put this in context, let's say we place 10 trades and we lose on 7 of them and we only profit on 3. With a 70% loss rate, you will find that you're still profitable, and this is why. If you're losing $20 every time and you lose in 7 trades, then you lose $140. But if you're making $60 every time and you profit on 3 trades, you make $180. That's $40 more than you started with. Okay, so you're losing 70% of the time. That's a place to start. Thereafter you get better, and if you're getting better, it can only improve. So I'm sure it makes sense now why you don't want to have a risk-reward ratio of 1:4. That means it will be 4 times harder to reach take profit than it is to reach stop loss. If you don't want your take profit to be too far to be reached, you shouldn't use a risk-reward ratio of 1:4 or more. To add another level of goal setting, now you're gonna keep to this discipline until you reach the next milestone. Starting off with $1,000, when we get to $1,500, we'll go and find out what 2% of that is, work all of that out again, and then work with that until we reach maybe $2,000, in which case we'll go back and find out what 2% of that is. A good way to keep track of your progress is by keeping a journal with the details about your trades, like the time of the trade, which can be affected by sessions, the instrument you're trading, fundamentals will have their way here, as well as the reason why you're placing the trade that you placed, so that thereafter, if that reason didn't bring a positive outcome, it's more than likely not a good reason to use next time. And if it does bring a positive outcome, you might want to look into perfecting that reasoning. That way, you work with your own psychology to weed out the certain things in your strategy that ought not to be there.
If you pair this with your knowledge of when and how to enter the market, how well you use your technical or fundamentals and sentimentals, you will have 2 good feet to stand on in this market.
Have fun trading smart.